All right, stocks rebounded in a big way today. So we talked about the possibility of this happening in a couple, in my last market outlook video, and we kind of did get an intraday rally yesterday, a pretty decent sized intraday rally. Didn't hold up very well by the end of the day, but today it did. Today we gapped up strong. We finished today strong. So of course that always brings up the question: have we bottomed? Right? Even though we've had lots of really good up days. Is this the one? Is this the one? We're going to talk about that and break that down. We'll see whether or not things have changed in other charts as to whether or not we can now kind of lean more towards the upside or not. We'll also talk about what drove a lot of the bullishness today. What's the reason why everything or things move so much? There's a lot of big moves in a lot of different asset classes, not just equities. And then our trade idea is a stock that had already actually bounced up previously on its own earnings announcement. So we're going to talk about how to trade it now that it's kind of itself kind of in a bullish, kind of quasi bullish mode, and see what we should do with it. So let's go ahead and get started. Today is Wednesday, March the 9th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's take a look at the market forecast first with the S&P 500. And you can see, again, a great day, up 2.5%. But you notice it did not get above the 23% retracement level, which it probably will tomorrow if it follows through at all with this bullishness. And we didn't quite close above yesterday's high point. Well, we guess we did by like a hair, 42.76.94, 42.77. But again, nothing significant. So it's kind of a little bit of a morning star candlestick pattern. This was definitely a piercing line candlestick pattern. So we're getting reversal, or you can call that a hammer pattern over there, with a doji coming after it. So we're definitely getting reversal patterns at these lows. But obviously the last reversal patterns didn't quite change the trend. And you can also see now too. Whereas before, the 38% Fibonacci retracement was well below the 30-day moving average. Now the 30-day moving average is sitting right on, or really close to that 38% retracement. So those two are going to really strengthen. And the fact that we already have a touch there, that we've already failed at that level, will just strengthen that as a resistance level. So there's a good chance that we can continue the bullishness up to that area. But a lower probability that we'd get through it. Not impossible, because that's how trends change. But you would expect resistance to hold until it doesn't. So we would expect that resistance to hold until it doesn't there. So the intermediate line's back below its market sentiment. They're both falling in bearish territory. Short-term sentiment's rising, so expect the near-term line to make its way into bullish territory. Again, the question will be, just like all these others, is how far up it gets. Now, the last time we did get up to above the 90th percentile, so it looked real. I mean, if you thought today was a bullish day, those 2 days were really bullish days. In fact, if you look at, what was it? What days were those? Those were the 24th and the 25th. So when you look at it from this perspective, right there is the 24th. Now remember, that doesn't do it justice, because look at that gap to the downside on the 24th down here. And again, we finished up with that gap of whatever, 3%, 2.5% to the downside, and then finishing up whatever that ended up finishing up, 1 point whatever percent. 1.5%. So that's a major move, intraday move. And then to follow that up with an actual 2% plus gain. If you think that today was a good bullish, that was a really, really good bullish day. Those 2 days in particular. And it brought the near-term line all the way up to the 90th percentile. So, if anything was going to change the trend, again, it failed at the 38%, and that's where it hit some resistance. But if anything was going to change the trend, that was, because that near-term line could not have been more bullish. It didn't reach the same height that the last near-term peak that wasn't so bullish. It didn't even get in the reversal zone. And then we kind of had a little bit of a near-term divergence there, with the lower highs and the slightly higher highs. So the question is going to be, this is a pretty bearish near-term low. where is the next near-term peak going to be? And my expectation is it will be somewhere in bullish territory, but probably not even that bullish. Probably something very similar to these two, where they followed up after a pretty strong bullish, but wasn't able to change the bearish trend. But and then we followed up with a couple bearish peaks where we got above 80, but only for a day. We didn't even get above 80 that time. So maybe we get above 80, maybe only for a day. Maybe we only stay in bullish territory for a couple of days. We peak probably around this 43.75 area again, and then halt at that point. We are more than 2.5% below the moving average still, so we're still relatively bearish from that perspective. The Nasdaq is not above that 23% retracement. It's got even stronger resistance at the 38% retracement because it's also got that long-term 23% retracement level of that post-COVID rally that we had just broken below, in addition to the 30-day moving average. So even a much stronger resistance than that. And you can see the near-term line getting out of bearish territory. And then finally, the Russell 2000, also pretty decent bullish candlestick reversal, but also not above the 23% retracement. Its intermediate line's actually not in bearish territory, so unlike the others, and we are actually trading above a rising moving average. That's why it's green. So I mean, that's not like the other indexes. So from that perspective, the Russell's actually better, but like the other indexes, we haven't been able to get above that. And also, like the other indexes, there's going to be some very significant resistance at the 38% retracement, because that's where that also, like the Nasdaq, the 23% retracement of the post-COVID rally is sitting there too. So very, very strong resistance levels. And you also see the points of control in there. I'll show you here in a minute. But it's going to be hard to get, it's going to be hard to change the trend when we have fallen as much as we have. Like, it would have been easier to change it if we had just bounced up right there. But we didn't, and we broke the new lows, and now it's not going to change on a whim, right? 1-2% update is definitely not going to do it. When you look at some of these other indexes, remember on here, when we're looking to be bullish, we're looking for a green arrow. So that means we're closing above the 10-week moving average, which you can see for the S&P 500 is still not even above the, it still hasn't crossed below, excuse me. The PPO is still falling. We still have a negative differential, so we don't have any of the three things on this chart that we need to be bullish. The Russell 2000 is the most bullish index, or at least the least bearish index. It also does not have a green arrow on the moving average here. We haven't crossed above that yet. We also still have a falling PPO, and the differential still negative on it too. And then finally your Nasdaq looking very similar. You can see that we are down below the 23% level. We are down down below the 23% level. Again, falling PPO, negative differential there. So it's very you can see that it's struggling. I mean, we don't have what we need to be able to change this around. If you take a look at the green arrows, 3 green arrow charts, you can see here that we have the red arrows on 3 red arrows still, though the MACD is rising. Let me go back to all of them. We have 3 red arrows on all of these others except for the Russell. The Russell has a green arrow on the moving average, and it's probably the closest to getting a green arrow on the MACD too. Remember, the green arrow on the MACD occurs when the MACD itself crosses above its moving average, but you can see that in and of itself isn't as significant unless we are also trading above the 17-day, which is the slowest number in the MACD, if we're also trading above that 17-day moving average there. So we're not getting that. And so a green arrow, again, is less significant. And you can see the volume today. It picked up at the end of the day. It ended up being less than what we've seen. So ideally on these big bounces, when you're really bullish, you like to get some big volume levels to really solidify. You can see on these bullish days, you got some really strong volume. The fact that it was less and it was below average kind of puts it, and with a smaller than average. Now keep in mind there was a gap in here. So when you look at the gap, we closed at 416 and a quarter. The low was at 422 at 85. So we actually had about a 6-point gap So that actually puts it above the ATR. But again, much bigger than average range usually also comes with a much bigger than average volume, like it did on all these others. And that wasn't the case today. When you look at so that's the S&P. So you can see again, we're still below these moving averages, still below the point of control. So it's another thing that will really solidify that resistance at the 38% retracement level. Look at IWM. You can see that, okay, you can see there's a pretty decent chance, but getting above the 30, when there's a gap between the 50 and the 30, we tend to fill in that gap. You can see we already did that on this decline. We did it right there. So it's a very, that's kind of what we do when you have a gap between a significant gap between the 50 and the 30, you can really just fill that in. And so considering that there is still a pretty significant gap there, I kind of expect that that's probably about as far up as we'll get to, is that 50-day moving average. And now that the gap between the 50 and the 200 is widening, again, the 200 is going to be a significant resistance if and when we actually start to fill that one in, especially with the point of control being, and the whole entire value area being up here too. That's a big resistance level. Looking at the Qs, you can see, again, barely at the 8-day moving average. It's not above the 17-day, and you can see that there's a lot of resistance above that 30. There's a big gap between the 30 and the 50. It's even just to get into that gap, and you can see how it fills in this gap right there when you're on that side. Just to get into that gap, you'd have to break some significant resistance level. So you're probably not going to do that until the 50 crosses below the 38 and the 23 or 38 and this 23 one as well. So I think at most we get up to the 17-day because that's where your big volume resistance is, and then we make another run to get below the point of control, because once it gets below that point of control, then you're going to be bearish for a while. See, we're still below the 23%. SPY hasn't got, or the value area, SPY hasn't broken that value area yet. Once it does, then we'll see more bearishness than what we have seen, and maybe some more volatility on a relative basis than what we've seen as well. Let's take a look at the DMI. You can see we're still in bearish mode here. Nothing's changed on the SPY, on the Qs. That's a really high ADX, almost a 40 on the Qs. And on IWM, the ADX is actually rising again, and we're still above 25 on that negative index, and the positive not even anywhere close to even getting above 20, much less 25. So nowhere near bullish reversal patterns at all. Same thing here, well below 50, well below 0. Same thing with the NASDAQ, same thing with the Russell. I mean, they're all very similar patterns there. Looking at the Ichimoku cloud, we're that close to a mature bearish trend again. Despite, even with today's rally, the Qs, even with today's rally, are still in a very mature trend. And then IWM is still in a noisy pattern. That's still very sideways. So it actually has ended its bearish run and hasn't really started a new one. It's been very choppy and sideways since we started this decline. It's actually been very good from a options inventory standpoint for our class that we do on Wednesdays. Looking at the Bollinger Bands for SPY, we are back just barely into the middle portion, the middle half, right? But just barely, right? So that's hardly like bullish. We're not even in the upper half. We're barely above the 51% level there on IWM. That's the most bullish, because the Qs are also barely into the middle. So again, these aren't the most bullish Bollinger Band. And once you get into the upper half, and maybe especially into the upper quartile, then we can talk about a change in direction. But while we're still in the lower half, and especially when we're flirting with the lowest quartile, we're definitely not. And these are not reversal. Today was a great day, but it wasn't a reversal day, and you can see that as well. I've been showing you in the hull. We talked about how we had some range here. We've been pretty volatile. We did move the parabolic SAR up yesterday, but we pretty much stayed within it, and we're still kind of there too. And so we're not really, like, we actually have a bearish reversal, but I still think I have a few bullish candles. We might actually have a bullish reversal first, another short one, before we actually start that bearish leg lower to the downside. I actually kind of think we'll probably be bullish depending upon this inflation report tomorrow morning, which is a big deal. If the inflation report's still very strong, then we might be right back to being bearish again, because really That's what started this. It wasn't the Ukrainian, Russia-Ukraine war. It was the inflation numbers that were really ramping up Fed rate hike possibilities and shifting them from basically no rate hikes at the end of last year for 2022, at least according to some Fed officials, to now 7. Right, by the beginning of this month, we were at 7 for at least beginning of last month, beginning of February, we were hitting expectations for 7 rate hikes and a 90% plus expectation for 50 basis point hike here in March. So that's damped down, but the expectations for 7 have ramped back up again to where they were at the beginning of February. So the Fed's still very hawkish, and if we get a strong inflation report, then that will continue to put pressure on them, and that's what's been putting pressure on equities. It's just been added to by what's the geopolitical issues, but that's not the biggest deal. And it'll be interesting to see how the geopolitical actually impacts actual business results versus just headline sentiment results. So that's what's going on there. If you look at the volatility, that's what I wanted to show. One of the things I want to show you, volatility, remember, never did spike. We still haven't gotten to. So, there's a really good tweet here that Brandon shared about all the times that we've had the VIX above 30 for 7 straight sessions, and you can see the 1 year returns coming from that are really strong, 20%, 25%. The 3-month returns are actually pretty strong. The average return 81% positive, and the average return is 8%. So the fact that we've been above fix 30 times, but 7 days in a row above 30 is pretty interesting. It is also interesting to notice that when you look at the previous instances, 20, 8, 10, and 11, and then 02 and 03 or 2001. So that was coming off of the spike, the 9/11, post 9/11 spike. But it's interesting to see that aside from these late 90s here, that a lot of these strong rallies in the VIX. So again, it was 2020. See, we were coming off of a big spike, and a lot of these moving averages were heading lower when they happened, and you can see we hadn't really dropped below 20 yet. And now, instead of coming down, we're actually on the way up. And the same thing, what was the other instances, was in 2011 and 2010. Well, if you look at 2011 and 2010, so we were coming off of, and there's 2008 as well, we were coming off this major drop. So there's 2010, again, a pretty significant drop down towards 20. And then, so we were above 30 after this big spike. We were above 30 again in 2011 after that big spike there. We were still kind of coming off of this one, making our way down until eventually getting to where the 20 was the peak, here after we finally established the bullish trend. And you can also see that too in 2002, 2003, again coming off of some pretty significant peaks. This was the major low point for that bear market. So all these recent instances were coming off of some pretty major low points. The question is, are we coming off of a major low point? You could argue that we're still coming off of a major low point because of the COVID move. So this spike right here, we're actually probably still coming off of that low point. The difference, in my opinion, versus some of these other instances is the CAPE ratio. The CAPE ratio is higher now than it was in 2020. Coming off of that low point there, it's higher now than it was in 2010 and 2011, especially. You were still down here in the low 20s when you got that. In 2002 and 2003, again, we were kind of in the mid 20s. So a lot of these previous, in the early 90s, we were coming off of lows here in the high double digits, like between 15 and 20. We're at 35 now, so I think it's a little different environment right now with the VIX coming off of a low point instead of coming down from a high, and the CAPE ratio coming down from a high point instead of coming off of a low, like we've seen in all the other instances. And the other thing that stood out to me too about that is the VIX ratio chart You cannot get above 105. Now, we'll start a day above 105, but we can't close a day. In fact, we've actually only closed the day above 100% twice. That's it. Out of all these days that we've been we've been above 30, we've only actually closed above 100% one of those days. So we're not really getting a spike in volatility that usually, like you see with some of these other correction moves that we've had over the last so many years, 15 years. So again, the correction with COVID. Let me look at that spike compared to this one. The correction with 2018. Look at that spike again compared to this one. Even early 2018 was a much bigger spike than what we're getting now. Look at 15 and 16 right here, 15 and 16. Look at the spike, especially when it first started in 15 compared to this one. And then finally, looking at 2011, look at that spike there compared to what we're getting now. We're at 30s. We're in the 30s. We've traded above 30 for 7 days, which is rare. But we're not getting this. It's the VIX 3M that's staying high too. Why is the VIX 3M staying high? Because, and that's the answer to that question is also the same reason why the skew is staying high. Because the market is not done above 130. The market's not done being worried about a big move, even though we've already experienced a big move. Right? Usually, when you get these big drops of however many percent, right? If you go to the zigzag chart here, when you get these big drops of 10% or more on the S&P, when you get these drops, that VIX ratio goes up, and we're pretty bearish. The VIX 3M stays low, like the VIX spikes, and the VIX 3M doesn't, and the skew drops because you've experienced what you were anticipating with a high skew and the VIX 3M being high. So the VIX 3M stops going up because that's 3 months out instead of 1 month. The VIX spikes on a relative basis, and you kind of set the low point. We haven't had that yet. We're down 13%. We haven't had the skew drop, which again is a signal that we have experienced what they were anticipating. So we haven't experienced yet what they were anticipating. The skew is still high. And that's even with the NASDAQ sitting here at a 20% drop, practically, 19.9, again on a closing basis. So that's the concern that, we might not, I don't think that we're done with this. And again, I've told you before that a correction is what I think we're in right now. And we have just barely started it, breaking the 50-day. We haven't broken this 23% level yet, but once we do, then you would expect we'd start to fill in this gap. Again, we already have done to a large degree on IWM, and how we're doing more of on the Qs now that the 8 and the 17-week moving averages have crossed below the 50 as well. So those are corrections that last a while, right? They don't just set a low point within a week or two and then we're done, apparently, because we haven't seen that yet. Let's see here. So I think that's the last chart I wanted to show you. I wanted to show you quickly here the intraday move. There is some, if we are going to be bullish, this gap needs to hold for that to be a runaway gap. If we fill in that gap in the next few days, again, inflation report tomorrow, FOMC next week. If we fill in this gap by that FOMC meeting and take away its runaway gap nature, then we are not done. This is not the low point. If this can hold and we can just establish a new higher high, higher low, we can get above this point of control, we can get above this 78% line here on that near-term run that we're still kind of consolidating. If we can get back above that, then now we're done. Last week's high point, again, the point of control volume, then we're done. 440, we get through 440 to the upside, we are bullish. If we stop at 440 or less, more likely right around 435, if we stop there and that's all we get, and we start to fill in that gap, then again, we're going to be bearish for a while. Again, not fall off the cliff, not doom and gloom. It's just trending to the downside. That's what markets do. They trend to the upside. I know we're not used to it, especially newbies are not used to it, but markets go up, they go down. We've had corrections like this in 2018 and 15 and 16. 2011, we've had multiple, and COVID, obviously, though COVID was exasperated, and exacerbated by was a much bigger drop than a normal correction, but still ended up just being one. But that's 4 corrections that we've had since the market bottom 2009. So these happen, right? This is a normal. If you started trading with Robinhood or whatever since the fourth quarter of 2018, since the COVID low, then you're probably not used to this. But this is normal, and I think we've also got accustomed to our corrections being like the COVID drop, where hey, we're going to drop big, we're going to drop it quick, and then we're going to form a V bottom, and we're going to go up. That doesn't happen, especially not without the volatility spike that we still haven't got. So if anything, we'd get a V bottom if we got that volatility spike. We haven't. The VIX 3M is still high. The skew is still high. The market is still anticipating a prolonged bearish trend. Again, more similar to what we saw in 15 and 16. More similar to what we saw in 2018, where we eventually got that VIX spike at the end of the quarter. So what do you think? Do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree. What charts or indicators are you looking at that would suggest why you think we're either a lot more bullish than we are than what I've shown you, or why we're a lot more bearish than what I've showed you? Share with us in the comment section below. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here on the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us 2 things. You liked your video today, and you want us to do another video again tomorrow. Quick way to give us feedback and let us know that you like our stuff. Of course, if you don't like it, you don't have to click on anything. You don't even have to watch it if you don't want to. Also, comment down there. What stood out to you tonight? What questions or comments you have about anything I brought up in the video? Post those in the comment section below. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle, at DavidSettle42. And join our Market Outlook Facebook group that we've created. Alright, if you're watching us here on our blog, check out some of these other things here on the page. If you click on this icon, that takes you to this page, our Market Outlook live video. This is where I review all the trades we've done in prior Market Outlooks to see whether we should stay in them or get out of them. We actually closed out one today. We also put on today's trade idea before the market closed. So we do that here in this video. It's live. It's on this page. Here's all the old archives of it as well. If you can get to it too by coming up here and clicking on live trade review in our menu. You can also see our upcoming classes. Click on view more. That takes you to our calendar. You can see all of our upcoming classes as well as all of our recordings. We have recordings that go back years, 4 years worth of recordings on this. You just go back to multiple years worth, 2000 all the way to 2018. You can also get to this by clicking on trading rooms. Click on this icon, this heart. It opens up this tab. Hit that like button. Also click on this thumbs up icon. Opens up this tab. Hit that like button. Again, the more you do that, it helps us get our content out to more of our followers because of how their algorithms work. The more engagements these posts have, the more people they'll show it to, right? Of people who already follow us anyway. It also benefits you because Twitter and Facebook promote content in your timelines from the accounts that you engage with the most. We try to make it easy for you to engage with us right here while you're watching. All right, now let's take a look at what's driving the price action. We'll do this relatively quickly since I went so long on that last segment there. But if you take again just a look at today, essentially today was, okay, what had been going on before, we're going to reverse it, right? So it was commodities dropped, gold, crude oil especially, gold dropped. It was just, I mean, we had some parabolic moves going on. And those parabolic moves reversed. Commodities are down huge. Gold was down big. The dollar was down big. Long-term bonds, see, that wasn't the case, prior to that. Prior to that, when you look at all this bearishness, when did the last leg of bearishness start? It started with, right about even just from that peak, from the February the 9th, if we were to go back. From February the 9th to yesterday, so February that would be the 10th would be the first day, to yesterday to the 8th. Again, look at this chart and you see, try that one more time. So the 8th, and this would be February the 10th. You look at that chart and you say, okay, well, stocks were all down, the Qs were down, IWM down, but the commodities was up huge, gold was up, the dollar was up huge, and you can see bonds. So essentially, it was just again a reversal of that, and nothing really more than that. I mean, a lot of these moves just flip flopped. Bonds were down, weren't up very much, and they were down again big today. But again, it kind of shows, in my opinion, the fact that bonds continue to drop. It shows where the Fed is, right? The market still, in fact, when you look at the 2-year yield here, it's still at the highest. I mean, again, when it spiked here in early February at 1.56% is where it closed. It did it on the idea that the Fed was going to be very hawkish and they were going to raise rates 50 basis points in March, right? You saw that on its historical chart. The probability of a 50 basis point spiked for just a few days, but it spiked up to over 90%. They were going to raise rates 50 basis points in March, and the odds of a 7 basis point hike or 7 hikes were over 50%. So this one right here, we're over 50% for 7 hikes by the end of the year. That happened there in February. Well, we're higher now than we were then. And the Fed's not going to raise rates 50 basis points, at least not what people are expecting. But what you have seen is the odds for 7 rate hikes have jumped back up to 50% again. They were earlier today. See, if you have for 4, you're at 99.7 for 4, 95.7 for 5, 79, so almost 80 for 6, and then 46. You were at 54 earlier today. Now we're at 46%. So you're still right around the coin flip, back to being a coin flip for that 7th rate hike. Even though this conflict's going on, which has actually damped down the expectations, what brought this down is all this geopolitical. But as you can see, the bond market's doesn't care. The bond market doesn't care about. The bond market just sees inflation levels and the real Fed funds rate at such extreme negative numbers that's going to put pressure on the Fed to still be relatively hawkish. And I don't think the stock market has come around to that yet. I think the stock market feels like, the Fed's going to be more dovish because of what's going on overseas. And the bond market hasn't quite caught that vision. Commodity prices, you can see why they dropped. I mean, they were rallied. They gone so parabolic, they dropped back down. But even that big drop of 8% on DBC only got you to just barely below the 8-day moving average. Crude oil, just barely below the 8-day moving average. We're not even below the 17-day. So, again, it can drop pretty far. But even there's a gap between the 17 and 30, which means if we break the 17-day, you'll probably just fill in the gap to the 30, and that's it. And still be relatively bullish. So, and that's where you'll encounter some volume support a little bit as well. So I think that we're in a mode right now where we're kind of releasing a lot of that parabolic moves, but I don't think we're going to change the trend of those parabolic moves. We're just going to now release some of that pressure and then get a move back to the upside. And you see that as well on the dollar. The dollar had been so bullish. Whoops. This one I wanted to look at. This one, the dollar had been so bullish. Finally, the euro made a big jump to the upside. I mean, one of the biggest moves the euro's had in a long, long time. And again, all it did was get you above the 8-day moving average. It still didn't get you back above the 78% line, which is the level that we had broken back down. I actually think it will, even though the markets may still be bearish. I think that will transition away from the dollar being bullish because of the geopolitical stuff to being the dollar being bearish because of the inflation stuff, right? That will put more pressure on the greenback and still put pressure on equities too, but just now with a bearish dollar instead of a bullish dollar. That was the result of the geopolitical issues that were going on, which will most likely mean that gold will rally. It's going to pull back here because it's gone parabolic, but it's most likely going to rally. The big jump in Bitcoin that we had, we're already back down 2% today, tonight. So, again, all it did was get you to these moving averages and not quite through that yet. So, we got to get above this 44.70, 45,000. You really got to get above that if you're going to be bullish again. So anything in between there, anything between this 45,000 and say 35,000 is just noise. It's got to break through one of those areas to get back to where it might be trending either back to the upside or continuing this bearish trend to the downside. All right, now let's take a look at our trade idea of the day, and I wanted to take a look at Target. Target has been interesting because its earnings announcement, it really pushed the price through. Big time gap to the upside, dark green shading the green line, just like that again. But then, we started to fill in the gap. So, and you'd expect we'll probably fill in some more of the gap, but we're not really going one way. We're still bullish, kind of. We got light pink shading, but we still got a green line. If you take a look at the long-term chart, it actually, we got some bullish candles here, even though we're kind of flirting with that red arrow. Probably by the end of the week, we'll probably stay green. So you have, you have this red arrow here. You have a rising PPO. You have a positive differential, and that red arrow might not be there by the end of the week. You look at its 3 green arrow chart. You have 2 green arrows. You've had 3. So we're definitely not in the pink area there. When you look at the 2-line version of this chart, you can see we're trading between moving averages. We are in a death cross environment, but we had gotten above the 50. Still below the point of control, but back above the value area. So it's setting up pretty nicely for more of a neutral trade. Considering that we have some highs established, but we also have a low established, as well as this gap. We're in a neutral zone on these indicators here. We're back in the neutral area of the Bollinger bandwidth as well, in the middle of the bandwidth of a relatively high bandwidth. So I would expect that bandwidth will probably start to fall here. And that sets us up for doing a iron condor spread, where I can come over here to its options, sell the 200 at the low 20 deltas, buy the 195. It's a little bit higher 20s, but I don't have a 235 option, so we'll sell the 230, buy the 240. So there's 2 of these. They're $5 wide. There's 1 of these, which is $10 wide. So it still ends up being a balanced condor. Position size fully, but again, it's only one because it's a $10 wide. We only do the 1 contract. But we get a pretty decent return, and those break-evens, you can see my upper break-evens at the top of this volume resistance. My bottom one is at the bottom of the gap. So we got a really, really good area we can trade in between. And we don't have to worry about earnings as we kind of just see if the stock stays in this area while its bandwidth starts to come back down again. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen that takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video, subscribe to our website at marketscholars.com for free. Like us on Twitter and Facebook as well. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.